Topic introduces netting and closeout procedures as essential mechanisms for reducing counterparty credit risk in financial transactions, particularly in derivatives and securities financing markets. Netting allows financial institutions to offset multiple obligations with the same counterparty, reducing the total amount exposed to default risk. Instead of settling each transaction individually, counterparties calculate a single net payment obligation. This process significantly lowers credit exposure, operational complexity, and capital requirements. Netting arrangements are especially important in over-the-counter derivatives markets where institutions maintain large volumes of interconnected contracts. Effective netting frameworks improve market efficiency, reduce systemic vulnerabilities, and strengthen the stability of financial institutions during periods of financial stress. The topic further explains the major forms of netting used in financial markets, including payment netting, closeout netting, and novation netting. Payment netting offsets obligations due on the same settlement date, while closeout netting becomes effective after a default or termination event. Closeout netting allows all outstanding contracts between counterparties to be terminated and replaced with a single net claim or obligation. Novation netting involves replacing existing obligations with a new net contract reflecting combined exposures. Legal enforceability is critical because netting benefits depend on whether courts and regulators recognize agreements during insolvency proceedings. Financial institutions therefore rely heavily on standardized documentation such as ISDA agreements to support enforceable netting arrangements. A key topic is the closeout process following counterparty default or contract termination. When a counterparty defaults, financial institutions must rapidly determine replacement costs, value outstanding contracts, and calculate net settlement obligations. Closeout procedures are designed to minimize uncertainty and reduce the potential for escalating losses during market disruptions. Institutions typically terminate all transactions under the master agreement and calculate the market value of each position. Positive and negative values are then netted into a single payable amount. Efficient closeout mechanisms are especially important during volatile market conditions because delays in valuation or settlement can significantly increase losses and create broader systemic instability. Topic also focuses on termination provisions that govern how derivative and financial contracts are ended before maturity. These provisions define events that permit early termination, including default, bankruptcy, failure to pay, regulatory changes, or material adverse financial developments. Termination clauses protect counterparties by allowing contracts to be closed when credit quality deteriorates significantly. Standardized legal agreements specify procedures for valuation, settlement, and dispute resolution following termination events. Financial institutions carefully negotiate these provisions because they influence liquidity management, collateral requirements, and counterparty risk exposure. Effective termination provisions improve legal certainty and strengthen market confidence by ensuring orderly resolution of distressed financial positions. The topic also examines trade compression as a technique for reducing operational complexity and counterparty exposures within derivatives markets. Trade compression eliminates redundant or offsetting derivative contracts while preserving the same overall economic exposure. Large financial institutions often maintain thousands of offsetting transactions with multiple counterparties, creating unnecessary notional exposure and operational burden. Compression processes consolidate these positions into fewer contracts, reducing gross exposures, settlement obligations, and regulatory capital requirements. Trade compression also improves transparency and operational efficiency while lowering systemic risk associated with large interconnected derivative portfolios. Regulators strongly encourage compression because it enhances market stability and reduces complexity within global financial systems. Finally, topics emphasize the importance of robust legal, operational, and risk management frameworks in controlling counterparty exposures. Netting agreements, closeout procedures, termination provisions, and trade compression collectively reduce credit risk, improve liquidity management, and strengthen financial stability. The global financial crisis demonstrated how inadequate legal protections and excessive derivatives complexity can amplify systemic vulnerabilities during periods of stress. Financial institutions must therefore maintain enforceable agreements, effective valuation systems, and strong operational controls to manage counterparty risk successfully. By integrating legal certainty, efficient settlement procedures, and portfolio optimization techniques, institutions can improve resilience and support the stability of increasingly interconnected global financial markets.